Whew, we are right up against a line for Canadian real estate here. When we cross it, things could really change. And at the very same time, one of Canada's biggest financial regulators made a controversial decision that could make matters worse. So let's talk about this controversial decision and how it could create more structural risk down the line for Canadian real estate, as well as the critical indicator that shows that the market is set to hit a major inflection point. So let's dive right into the information and make sure to subscribe to the channel if you haven't already done so to continue getting Canadian financial updates just like this. Today we're talking about, and we've talked about it on the channel before, OSFI. This is the Office of the Superintendent of Financial Institutions. Essentially, this is the regulator of the big banks and big financial industry in Canada. They're the ones that set the rules for the big banks, the big insurers, the big pension plans, these types of folks. They say their main focus is making and changing rules so that there's more financial stability in Canada and structural stability in the financial system so that things don't collapse or any worst case scenarios happen. We talked about one major change they made earlier in the week, that is to their DSB, the Domestic Stability Buffer, essentially telling Canada's big banks, we don't know what the future looks like, so we're going to require you to keep more cash on hand as a reserve fund in case things get a little bit rough. And that was a big problem for one of the banks, it seems, because BMO was planning on buying out another bank's operations in the US, and because they have to now keep more cash on hand, well, they don't have the funding in order to actually complete this deal. So a little bit of fallout there. If you want to learn more about that side of things, the DSB, I'll link the video right here. But the critical decision that they just made relates to their other rule that they incorporated back in 2016 that applies more specifically to the Canadian real estate market, and that is the mortgage stress test. You might already know about the stress test, but here's a quick recap. Back in 2016, they brought this in to make sure that people, when they were qualifying for mortgages at different interest rates, at this point in time is around 3%, they didn't have to just be able to afford the home at that interest rate of 3%. They actually had to be able to afford it at a higher interest rate as well. This is the test, the stress test. At this point is around 4.5, 4.75%, a significant interest rate increase from the one that they're actually having to pay. The idea is that, hey, if interest rates go up in the future, which we now know they certainly have, well, these people are going to be able to afford it because we tested them. Or in a worst case scenario where they lose their job, perhaps they now, because they bought less house than they could actually afford, can actually handle that situation. And so as interest rates have gone up dramatically, so too has the rate that people need to qualify for a mortgage at. Their stress test rate, it's gone up in tandem here, and we'll get more into that in just a moment. In order to drive home the impact of the stress test, especially in today's world where things have changed dramatically, well, we're going to do an example here where there are three drastically different examples of how the stress test applies to people. And for this example, we're going to use today's average home price in Canada across the entire country. The average home price is $644,000. We'll just use $650,000 to make our math a little easier. I remember how low interest rates were over 2021, late 2020, all the way into very early 2022, around the 1.5 all the way up to sort of 2 range. For example, let's use that 2% as our interest rate. For the average home of $650,000 at that very low interest rate of 2% with a typical mortgage amortization, 25 years, this is all kind of standard stuff, we can get to the monthly amount that you'd have to pay on this mortgage. And for this example, that is $2,752.43. And as a quick rule of thumb, you can generally multiply a mortgage payment by 3 in order to determine how much you'd have to be making on a monthly basis to be able to afford that home. So for this example, I think that averages out to somewhere around $8,250 per month to be able to afford this $600,000 home. Now, if we look at today's interest rates, at least at the major big banks in Canada, we can see it's a lot higher. For this example, let's use 6%. So for that same house, $650,000 at a 6% interest rate, well, things change dramatically here. You can see that the monthly mortgage payment is $4,158. We multiply that by 3, we get to somewhere around $12,600 earned a month in order to be able to afford this mortgage, $12,600. Now, if we add on the stress test, which in its current form adds another 2% onto the rate that you actually have to pay on your mortgage in order to be able to qualify for that mortgage with the stress test, that brings us to 8% for the interest rate, whereas like the actual interest rate that you're paying is 6%. That's the 2% sort of buffer there. The stress test, well, that changes your payment even more, leading you to a monthly payment of $4,960 for the average Canadian home. If we triple that to get to the amount that you have to make per month in order to be able to actually afford this, well, we get to just under $15,000 at the current 8% interest rate. So when interest rates were low back in 2021, you could be making $8,250 to buy this $650,000 home and afford it. But now with the higher interest rates, you have to be making $12,600. And when we take into consideration the added stress test on top of that, in order to afford the average Canadian home, you need to actually be showing the income of $15,000 per month. But how does this all relate to the stress test and this big announcement that was made by OSFI? Well, many people have begun to say that the stress test, given the current economic conditions with interest rates way higher than anyone really expected them to be at this point, they're saying, hey, maybe this stress test should be changed a little bit because the projection for interest rates is that perhaps they'll stay sort of stable over the next year and then slowly start to come down again. Maybe the stress test should change as a result of that sort of new situation that we're in. And we're going to get to how this stress test and everything else we've talked about have pushed us up to this major line that it looks like we're going to pass this major real estate economic indicator. But first, you need to listen to Benjamin Tal. This is the chief economist for CIBC, and he comments on his concerns about leaving the stress test the way it is right now.
You know, when they came up with the stress test, I was very vocal about it. I said, I'm fine with it as long as it is linked to market interest rates. It doesn't make any sense to have a 200 basis points stress test on 1% interest and 7% interest. It doesn't make any sense whatsoever. You cannot use the same spread. You have to adjust it based on where the market is. And they are basically saying that they're going to review it once a year. We are putting a lot of pressure on them. I'm not saying cancel it, but I'm saying adjust it to reflect where the market is. Yes. And I think that there are many ways of doing it, because the way it is now, it just doesn't make much sense to me, quite frankly.
So Tal is advocating that this mortgage stress test should be more linked to market interest rates, perhaps going up or down relative to whether or not rates are up or down relative to the past number of years, right? But it seems OSFI has not agreed with the people who are saying that this should change, because they just came out with this statement this week. We can hear it right here. Today, the Office for the Superintendent of Financial Institutions announced that the minimum qualifying rate for uninsured mortgages will remain at the greater of the mortgage contract rate plus 2 or 5.2%, essentially saying if your mortgage rates are below 3.25%, then automatically you have to qualify at 5.25%. But if it's higher than 3.25%, well, then you have to qualify at the rate that you're getting plus 2%. That's why we added 2% to the 6% that it is today to get to our 8% qualifying rate in that example we did earlier. They said that they looked at housing market data and broader macroeconomics, but also that they consulted with both the Bank of Canada and the Department of Finance Canada. That's the federal government's finance department led by Chrystia Freeland when setting this minimum qualifying rate. And they said that they opted not to make any changes here because of the current unexpected nature and unpredictable nature of the economy at this point. They're saying that they're going to continue to review whether or not this needs to change. But pending the outcome of this review, they'll make that decision, although the economic environment could result in a more immediate change. So if things sort of shift here in the market, then they could change the stress test without much announcement of it. Now, there are definitely two sides to this. The stress test is definitely important, and it makes sure that there's less structural risk, right? And that people can weather these interest rate hikes and qualify for more. It forces people to buy less house than they could actually afford at their maximum income rate. And it also takes into account that, hey, someone might lose their job. So being able to say, okay, there's a little bit of buffer here means that there's less structural risk inside of the real estate market. But on the flip side, there are some arguments that can be made that this stress test doesn't do what it is intended to do and could in fact add more structural risk into the real estate market. Take a look at this.
The issue is that people will go to alternative lenders and pay even higher interest rates. So you increase the risk in the market by doing so. Another factor that we have to realize, one of the reasons why so many people are now stuck with variable rates mortgages that will be adjusting very, very quickly is because of the fact that for a period of time, and you know that better than anybody else, passing the stress test for variable was much easier than doing the fixed. So everybody moved to variable. Yeah. So we reached a point where 60-70% of originations were variable. And now those people are seeing this huge increase in interest rates. So I think that in a twisted way, that the stress test raised the risk in the market by pushing too many people to variables. And I think that if we don't change it, it will shift people to alternative lenders, which I don't think is the solution to the crisis.
So he makes a couple points there, and the first one is that the stress test could be pushing people towards non-traditional lenders. We often in lending talk about A lenders or B lenders, A being like the most credible, largest, these lenders, these are like the big banks, the CIBC, TD, RBC, BMO, these types of banks. These are A lenders, and every single mortgage loan that they give out, they have to follow these guidelines of OSFI and have to do this stress test before they can give a mortgage. They have to follow what's called the B20 guidelines, which are a sort of set of mortgage underwriting principles that these institutions, the big ones, the ones that are heavily regulated by OSFI, have to follow to a T every single time. But on the tier down from those A lenders, we have B lenders. These are often credit unions or other mortgage lending organizations that can provide people alternative lending solutions. And they have a certain type of product called non-conforming product. These are sort of mortgages that they can sort of get around these B20 guidelines. They don't have to follow the stress test. However, there are some downsides for the people who go with these loans because often they're at a higher interest rate, usually a percentage or a percentage and a half higher than the rate you'd pay at one of the big banks. And on top of it, there is a lender's fee that's often charged, which is a percentage of the entire value of the mortgage. So if you have, just to make it simple, a $100,000 mortgage, if you have a 1% lender's fee, well, then you have to pay an extra $1,000 just cash straight out of pocket. So Benjamin Tal suggesting that because we have this stress test and it's so high, well, we've actually pushed, or we're going to push more people to these alternative lenders. While they might have to actually be at a higher interest rate in terms of what they're paying, they can actually afford that higher interest rate than the lower interest rate that they also have to qualify with a stress test for, right? Is that sort of starting to make sense? We could push people towards these more risky lenders that are actually not as financially wise of a decision for the people who are doing this borrowing. The next claim he makes is that the stress test actually pushed people to get more variable rate loans during certain points in time during the pandemic, and now they're feeling the pain of that because, well, their monthly payment has gone up significantly, or if they're on a fixed payment variable rate, they could be hitting their trigger rates where they're only paying interest on their loans and they're not actually paying down the house. If I zoom in here, I think you'll get a better idea of what I mean. This blue line here is the variable rate mortgage rate, and the gray one is the fixed rate. The previous floor for the stress test was at 5%, right around this point. So at any point when a fixed rate mortgage was above 3% and the variable rate was below 3%, then we'd have a situation where you could pass the stress test more easily with the lower rate variable rate mortgage than the higher rate fixed rate mortgage. So what he's saying is that it drove more people to go with the variable rate, which is not working out for them now, especially in adding some structural risk to the Canadian financial landscape because of this sort of spread and the influence of the stress test to push people towards variable rate mortgages. So arguments can be made about the effectiveness of the stress test, but one argument that is not an argument, it's just true, is that this decision and the high stress test, as well as high interest rates, is just going to be a further downward pressure on real estate prices going forward. I mean, remember the example we just did? You have to be making $15,000 a month as a family in order to qualify for the average home or a mortgage of the value of the average Canadian home. And that brings me to the topic I mentioned at the very beginning of the video, that line that we're slowly getting pushed up closer and closer to, and when we cross it, it can make a big change on the Canadian real estate market. And to understand that line, you first need to understand a key real estate indicator that we look at here in Canada, and that is called the SNLR, or the sales to new listing ratio. It's super easy to understand. This sales to new listing ratio simply describes the amount of homes that were sold in a given period of time relative to the amount of homes that were newly listed on the market in that same period of time, and how those two numbers relate to each other. So if I zoom in a little bit here, I can give you a better example. This is an example of month one. So if we say over the course of one of these months, well, we had 5 new houses listed on the market, but also 5 houses sold, which would mean that our sales to new listing ratio is 0.5, or we could say like 50-50, right? But in the next month, if there's 8 sales and only 2 new homes listed, well, all of a sudden our sales to new listing ratio is way higher. It would be 0.8, right? Or like 80% of the, 80, oh my gosh, I can't talk, 80% sales, 20% new listings, right? This is the ratio. And for the final example here, we have month 3. Things change significantly for this. Actually, let me clear this and move over a little bit so that you can see if all of a sudden we only have 2 new sales and we have 8 new listings of homes, then we have a sales to new listings ratio of 0.2. All you need to remember is that if this number is higher, that means there are more sales going on than there are houses that are getting listed on the market. And when this number goes down, that means that there are more houses going on the market than there are people buying it, right? This ratio is often used to describe what type of market we're in. You've probably heard the term seller's market or buyer's market. We use this sales to new listing ratio to say, okay, which one of those are we in? And let me explain. If we have a balanced market, that means we have roughly the same amount of people buying homes that are sort of selling them. We have a balanced market. We'll typically say that we'll have a sales to new listing ratio of between 40 to 60% or 0.4 or to 0.6, depending on how you sort of frame those numbers. So that's a balanced market. On the upper side of that, if we have a 60 to 100% sales to new listing ratio, well, that means it's an extremely hot market. This is a seller's market because there are just so many people trying to buy and not enough homes for them. And then on the lower side, well, if we have anywhere between 0 all the way up to 40, we'd call that a buyer's market. That's the point in time where buyers have more leverage. Prices are probably coming down significantly. Sellers are a little bit scared because houses aren't selling like they used to. Buyers have leverage. They can get a lower price or better conditions. And the line between 2 of these different market types is the line that we're being pushed up to here. You can actually use this chart to sort of see the sales to new listing ratio over time. That's the red line. You can sort of look at the right-hand side here to see what that percentage is at any time. And it describes basically what our experience was over the past couple of years. We saw far more sales than listings over the course of the past couple of years. And that's why the sales to new listing ratio is just so darn high, almost reaching 90% at its peaks, and sort of hovering around the 70 to 90% area, well in the range of a seller's market. And once interest rates started to change, well, so too did the sales to new listing ratio. We went down, and by the summer of 2022, we had actually entered the range of a balanced market between 40 and 60%. And on a national average, as we speak right now, we are sitting at 50%, which is right in the middle of a balanced market. But it's important to notice that, okay, we're looking at Canada-wide statistics here, but Canada-wide isn't where a lot of the increases in housing prices and a lot of the most impactful real estate changes take place. Take a look at this. RBC's chief economist recently said that looking at their data that they have for different markets across Canada, in Vancouver, Victoria, Fraser Valley, BC, Toronto, Ottawa, Hamilton, London, and Niagara, largely in BC and Ontario, where we've seen dramatic house prices increases. Well, now we're starting to see this ratio of sales to new listings, or SNLR, sales to new listing ratio, close to 40% or 0.4, and that is the line that we are at. That is the threshold between a balanced market and a buyer's market. And it's looking like we're trending in the direction of entering a buyer's market, certainly in these unique markets, but we're on the trend line as a national average or across the entire country of actually entering into a buyer's market. And that could dramatically change things. Once we pass that line, that's where we really start to see the price decreases, the sort of rapidly increasing reduction in real estate prices, potentially at an even faster pace than we've seen over the past 12 months here in Canada, or a little less than 12 months, like 8 months since we started to see the interest rates dramatically peak. So we could see a change in the pace on how quickly real estate prices change from here on out, with buyers suddenly being, for the first time in what seems like over a decade, the ones that are in the powerful position, in the driver's seat when it comes to real estate negotiations. Now, obviously, that was a lot to talk about. We covered the OSFI changes, the lack of a change to the stress test, and resulting in people having to qualify at 8%, $15,000 per month being the average amount that you have to make in order to afford the average Canadian home. Pretty wild. What do you think about that? Are they going the right direction? Should OSFI have changed something? Or do you think it's maybe healthy to keep interest rates even higher than they actually are for the next little while to cool things down in the economy. Let me know down in the comments, and let me know what you think about this sales to new listing ratio. Do you think that this is something that's going to sustain, or do you think we're going to maybe eke back up to that balanced market or even enter a seller's market again in the next couple of years? Let me know in the comment section below. I read every single one and try to get back to as many as I possibly can. And if you haven't already done so, make sure to subscribe to the channel if you want to continue seeing Canadian focused financial updates right here on the YouTube platform. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.